Hi, welcome to this week's edition of the weekly wrap up. The week gone by was a positive one for the Indian markets, with the benchmark indices ending the week higher by about 1.7 to 1.9%. Mid caps rose by about 2.3%, while small caps rose by almost 1%. Looking at the sectoral indices, gains were seen across the board, with metal, pharma, and oil and gas stocks being the most in favor, while auto, banks, and consumer durable names were amongst the slowest gainers. A key development in the week gone by was that of the US Fed hiking interest rates by 75 basis points. It has done for the fourth time in a row. While this was largely expected given the higher inflation rates, the Fed has said that the rate hikes going ahead will slow down, and thus one can expect a 25 to 50 basis point hike going ahead. With this hike, the benchmark policy rates now lie in the 3.75 to 4% range, which are the highest levels since the GFC. However, seemed to have spooked the market participants in particular was the comment that the terminal growth rates will be higher than anticipated. This, in some way, however, was expected given that the inflation levels currently are 4x that of the target set by the Fed. As for the situation in India, where the RBI has set an inflation target of anywhere between 2 to 6%, the prevailing rates are at about 7.4%. In the RBI meet, which is scheduled for the next month, in the first week of December, a 35 to 50 basis point hike is expected. The RBI does expect inflation to come under control by 1Q FY24, largely led by lower food prices. Having said that, in the short term, it seems that developments from outside of India are factors that will drive market sentiments. While Indian markets have done well in terms of staying put and outperforming their global peers over the last year, a large part of this is because of India being used to a relatively higher inflationary environment when compared to the developed parts of the world. As a result, the delta in discount rates is way more prominent in the developed parts of the world. In addition to this, the Indian economy seems to be doing fairly well when gauged by corporate numbers that have been coming out, thereby showing growth in earnings as compared to a scenario where there is a high probability of recession in other parts of the world. This, combined with a very strong participation of domestic investors, has supported the strong selling activity of FPIs, especially over the last one and a half years. In the year till date, for example, for every 10 rupee that the FPIs have pulled out, the domestic funds have invested about 8.5 rupees. Having said that, what needs to be gauged is whether this trend can continue. One interesting chart we came across recently is that of the ownership of the Indian stocks. As per the NSE, FPI ownership currently stands at 18.4% as of the June quarter of the entire NSE universe. This level of holding was last seen about a decade ago. FPI ownership hovered around the 20 to 23% mark in the years between 2013 going up to 2021. The lowest FI ownership that we have seen in recent times was around 15%, which was just after the GFC. On the other hand, the domestic mutual fund ownership is close to its all-time high of nearly 8%. As can be seen in the chart, this number has been on a sharp rise ever since 2014. We also looked at where the FI money is largely being invested. But before we get into that, we would like to show this chart which indicates that 5 sectors, namely BFSI, IT, FMCG, auto, and energy, constitute around 2/3 of the weightage of the Nifty 500 index. And if we look at these sectors and their contribution in the Nifty 50, that number would go to as close as 80%. As such, it would be fair to assume that most of the institutional participation will be concentrated in these sectors. But within this, FIs seem to be overweight on select sectors, namely BFSI, where there is a nearly 6% overweight position versus the index, utilities and energy. On the other hand, domestic mutual funds seem to be bullish on financials, industrials, consumer discretionary names, and healthcare, while they are underweight energy, consumer staples, and utility names. Given all of this, it does put us in an interesting position. DMF ownership is at its all-time high. FI ownership has come off considerably from its highs, and all of this is happening at a time when market valuations are slightly above the long-term averages. But with a large part of the Nifty earnings expected to be driven by the BFSI space, a lot would hinge on this sector to be able to keep the markets afloat. Having said that, clean books and bottoming out of the credit cycle is something that makes the outlook for the sector quite favorable. Amongst the many risks that could emerge, including any black swan event impact or a new unknown that emerges, one aspect investors should be ready to stomach is the possible volatility in the BFSI space given the FIA's aggressive ownership. This, along with the domestic investors' ability to set off any FII activity, also needs to be kept track of. We say this because the yearly performance of stocks has been flat. The rising interest rate environment has made fixed instruments a more attractive asset class, and market valuations are above long term averages. We'll be keeping a tab on these aspects closely and will share our views over time. That's it from us from this week's edition of the Weekly Wrap Up. Have a great weekend.